Hi, welcome everybody. We're pleased to have you with us today. I'm Erich Patten, Chief Investment Officer of Cutler Investment Group. I'm also joined today by Bryan Knutson, Senior Wealth Manager here at Cutler. And we're going to be talking about elections, the virus, and the markets, and Cutler's view. This is part of our quarterly webinar series. You're always welcome to join us or to watch this later. It will be on our website, cutler.com. But if you have any questions throughout, please feel free to provide them in the Q&A or reach out to us afterwards. So let me share my screen here and we'll get started with the presentation. All right, thank you very much. We'd like to start off with some disclosures. Just mentioning that these views are as of a point in time. As new information becomes available, we will be adjusting our point of view and our market outlooks accordingly. But as of today, this is the best information we have available, and we're going to share that with you and discuss what it means for the markets and how we might interpret that for your portfolios. So let's jump right into it with the election. It's what everybody wants to talk about these days, and it's right around the corner, just 20 days away. 19 days away. This is a current polling average compared with the 2016 polling average for some of the battleground states out there. And as you can see, Joe Biden is a pretty heavy favorite at this point in time. The 538 forecast believes that Joe Biden is about an 88% chance of winning. The betting odds, where people are putting actual money on who will win the presidency, has about a 66% chance for a Joe Biden victory. That is something investors should take into account, the likelihood that we will see a Biden administration, but you shouldn't eliminate the possibility that we could see an upset. After all, no one is forecasting 100% chance of either outcome. You'll see here in Wisconsin in 2016, Hillary Clinton had a 6.5 point polling average margin. Trump ended up winning that state. So we could see some upsets heading into November 3rd. But for now, we're assuming a Biden administration is really the best assumption for investors. And what does that mean? How should you be adjusting your portfolio accordingly? Well, this next chart, it's a nice chart provided by Charles Schwab, and it essentially says you shouldn't be doing anything. Look at how the market has performed regardless of who is president. Whether there's a blue shade or a red shade on this chart, it is almost exclusively positive, almost exclusively favorable for being a stock market investor. So we would advocate maintaining your portfolio, staying invested, not trying to time the market based on the election, but continuing with your path. Now, where it does make a big difference is that tax policy will likely change. And as an example of that, one proposal that's been thrown out by the Biden administration is to eliminate the step up in basis. Now, the step up in basis is when you die and you pass a security onto your heirs, they don't inherit it based on your original cost. They inherit it based on the value of that security at the time of death. So the tax liability then is essentially eliminated. If that step up in basis were to go away, investors would change their behaviors quite a bit. You would want to be gifting these large appreciated securities well beforehand. Or perhaps if you do any charitable distributions, charitable contributions, those low cost securities would be an excellent way to do that. So gifting strategies could potentially change under a Biden administration. We think there's some definite financial planning and estate planning changes that clients should think about and consider. But in terms of adjusting their investment portfolio, stick with the plan is the mantra that we think is best. So what has happened so far this year? And Bryan's going to talk a little bit about where we are and where we're going with the markets. Bryan?
Thank you, Erich. So this chart, thank you everyone for joining us. This chart here shows just how extreme the market reactions have been this year Much of this due to the virus. We talked about the elections already. The virus, of course, is a large part of sentiment out there politically and otherwise. This chart shows just how extreme this environment has been by showing the percentage, not the total number of days, but the percentage of trading days where we have had moves up or down in the S&P 500 stock index of 5% or more. What we see back in 2008, there were a significant number of those changes. Many of those were negative. We might remember that in 2008, it didn't start until the drop, I should say, didn't start until late into that year. It came down into the end of 2008, didn't really start to rally until March 9th, as some of us probably remember, of 2009. So that period was stretched out over about 6 months. Here, it happened, it being these huge drops and then recovery back, largely in about 2 months. It felt like, you know, by the time you got a beer and came back to the couch, it was already done, right? You had already seen such a rapid drop and then a rapid recovery back. We had the sharpest drop in history. We had the largest 100-day rally in history. We went down about 33%. And for those who know how this math works, if you drop 33%, you need to gain back 50% just to get to neutral. Well, we did that. And then we actually went above that mark. Now we're sort of bouncing around a little bit above, a little bit below. And this chart shows that we had 8 years in a row, 2012 through 19 inclusively, we had 0 of those days. That, as you can see going backwards, is a bit more unusual than having 1 or 2 along the way. We had none. And then we had an extreme number of those. Thankfully, we haven't had any for a while, but and this year's not over yet. Feels like it will never end sometimes. We don't know exactly how that's going to end, but so far, that level of frothiness has subsided. We've had up 1%, down 2%. It feels like a lot because the numbers are so big, but as a percentage basis, it's not that unusual. What is unusual is the extreme variance in returns that we have seen by different types of not only sectors, but subsectors. There are 11 sectors that make up the S&P 500. They range from technology to energy and lots in between. What we have seen this year to date is tech and consumer discretionary are again leading returns. Energy is the laggard in returns. But if you lift the hood and look a little deeper, what you'll see is, as this chart shows, online retail is by far the #1 gaining subsector. That is important to know. But then when you go beyond that, we get down into areas you might not think of, like home improvement. Well, we all know we're spending a lot more time at home. Look, I'm here in my office, but many of us are at home. And that is something that's gained a lot of attention, your Lowe's and your Home Depot, areas like that. One other thing that is interesting to note here is that the real estate investment trust, the REIT world, many would think of that as an area that's being crushed because who's going to work, and we have some rent issues perhaps for people who can't pay. However, industrial REITs, as you see on this chart, are quite a bit up. So it's not always or never with some of these sectors. There's a lot more nuance underneath it all. And at the end of the day, what we've seen, this chart is through the end of September, shows a gain of about 5% for the S&P. It's now closer to about a 9, but it's not just tech or just, it's not just tech gaining, it's not just energy losing. And actually, one other point that's important to know on this, Amazon is not a tech company by the S&P standards. Neither is Facebook, neither is Netflix. These are tech-related entities that are not tech companies. So if you think I'm just going to buy the tech sector, as that happens right now, it is almost literally 45%, it was almost half, I'll say. It's about 45% Microsoft and Apple, and then some smaller pieces of other things. That's not unusual. Many sector type funds are that way. That's why it's important to look deeper and look into what these companies actually do to decide whether or not you want to own them. And then Eric's going to talk about some companies that maybe you might not think you'd want to own, but maybe you do.
So we get asked quite a bit, is the stock market in a bubble? And one thing I think the chart up above that Bryan was talking about is the stock market is not in a bubble. There may be certain companies that are in a bubble that are trading irrationally. But if you look at that chart, a lot of the sectors of the S&P 500 are negative. A lot of them are fairly flat this year. So very rational investing behavior on behalf of the S&P. But the bottom half of the chart shows what might be some irrational behavior. In the Russell 3000, there are 416 money-losing stocks last year. If you had just bought them carte blanche, the average return from that investment would be 57%. We've said quite frequently, the stock market forecasts future profitability, not today's profitability. And that is really demonstrated by the fact that all of these money-losing companies have been doing so well. Now, we don't think you should be chasing that investment. We think you should be investing into good values in today's stock market, perhaps some of these sectors highlighted above that have underperformed in the current economy. But it is something to be aware of, that those investments that have done poorly in the past have been doing very well this year. So Bryan, how's the consumer been doing? The consumer is what, 70% or so of the economy?
It is exactly about that. Yes. So the consumer has had to absorb the impact of the virus, the impact of some uncertainty in the election, although, as Erich noted before, it seems like consensus is leaning one way, but again, so it was 4 years ago. Through all of this, the consumer is 70%, just over 2/3 of our economic activity. Their willingness, our willingness, all of us, to go back to what we're used to doing, what we love to do, is going to be a huge driver of whether or not this economy can get back to where it had been. We saw the biggest drop in GDP history in the second quarter, the biggest rally in the GDP, estimated, because it hasn't come out officially yet, but the biggest estimate for a rally in GDP history for Q3. Many prognosticators expected that, but you still have to live through it. That's really hard. What we see here is some very widespread indicators of willingness of the consumer, of those with discretionary capital, to go out and use that capital. A few of these that are most important would be mortgages. Mortgages went from, so every one of these starts with a baseline before virus impact began, and then the drop and ensuing rally back up of whatever that a particular indicator is. For mortgages, we started with a solid number of mortgages. Rates have been low for a while, lots of activity out there, both on purchases and refinances. What's happened since then? Rates have come down, come down, come down. There's still activity out there. I know I'm part of it, and so are many clients that I've talked to. And what are we seeing? We're seeing significant refinances and purchases, sometimes both. And we have seen not only has that recovered, it's come up even higher than it had been before. Some other areas that have done well, or starting to show that they are doing better, would be seated diners. So this would be folks going out to dinner, not going to McDonald's in the drive-thru, but actually going somewhere to sit down for a while. That went from what had been normal to minus 100%. No one in any state, regardless of political affiliations and whatever, nobody could do it. Now you can in many places. You still can't in some other places. So we're seeing that that number is quite a bit better. It went from minus 100 to somewhere around minus 40. There's a little bit of slippage now, but it shows us that there is willingness. Some other areas to look at would be, that's very important, would be air travel. So air travel has two aspects to it. How many flights are there and how many flyers are there? We are seeing from this chart would indicate that flyers are showing a willingness to sort of come back. Some of that is going to be because they have to for work. Some of it's going to be because they want to. How much of each of those do we have? Well, that remains to be seen. What we are not seeing is, what we're not seeing as much of a drop in is flights. And I can tell because airplanes are going over my house all the time now that I didn't notice 6 months ago. There are more flights than there were 6 months ago. How many more flyers will there be? The discrepancy in that number is one big reason why airlines were one of the big droppers on that chart we looked at before. But many of these are trending up. We need to see if they'll continue to trend up. How much further can they go? And this next chart will show us the ability for many people to be able to actually make that increase in their activity. What we see on the left-hand side of this chart here is we had been at, as recently as January and even into February, the lowest unemployment rate in at least modern market history or modern economic history that I've seen, about 3.8%. Okay, we have about 150 or so million workers in the workforce. We then lost 22 million jobs. Many of those because they just couldn't go anymore. Many of those because there were things that didn't have the demand when you didn't have the supply. Okay, so what happened since then? We started to get massive recovery back early on, probably more so than anyone would have expected. What have we seen since then? Some weakening in that. But to be fair, I mean, headlines play headlines to grab your attention. But if I expect to get back 5 million jobs over the course of 3 months, just to make up a number, and I get 4 million of them back in 1 month, I can't expect necessarily I'm going to get all the rest of them back just as quickly. It doesn't work that way. What we see on the right-hand side of this chart is where are many of those jobs still not refilled. It is in leisure and hospitality, so restaurants again, to talk like we did on the previous slide, and Disneyland, and ushers at a football game, whatever it might be. Some of those are going to be very specifically tied to whether or not that activity is even allowed. So what do we see there? Loss over 8 million jobs, a massive number, and have rallied back about 4+ million of those. But what does that still leave? Over 4 million jobs. Sliding over to further right there, what I can see is some other areas like medical care. We had lots of activity, lots of attention, of course, on COVID, obviously. But what that meant also, especially around here, I noticed, is other staff were let go because they had to refocus their efforts. Well, some of those folks have come back to what they are used to doing, or maybe something else. Some of them have not. If you go further over to the right, you see some, some areas that get a lot of attention and a lot of scrutiny. But in our developed economy, things like manufacturing, construction are important, but they are not that large of a volume of jobs. They're very important jobs, especially politically, because there's lots of variance in construction activity and things like that. And we want to bring production back to America. Look at this, there's over 1 million jobs there. But again, that's out of 150 million. This is not, 1 million jobs were lost, I should say. It's not nearly the driver that more discretionary activity is, because we're a consumer-driven society, or a consumer-driven economy, at least here in this country. We need to get more of this activity back. How quickly and whether or not at all some of those come back will be a big driver on where we can get that unemployment rate back to.
Yeah, there's still 25 million people on some sort of unemployment insurance in the United States right now. But that would have been much, much worse if not for, to a large extent, this chart that you're looking at here. And this chart shows the major central banks' total assets, the Federal Reserve, the European Central Bank, and the Bank of Japan, since the Great Recession through today. And you can see a very strong correlation of this chart with stock prices. We've had a pretty nice stock market for the last decade or so. This year, these three central banks increased, just in a matter of months, $6 trillion. A large extent of that was led domestically by our Fed. We've had a very aggressive response from our institutions, both the Federal Reserve Bank and the government. We're currently in deliberations for another stimulus package, and that would be stimulative as well for the stock market were that to come to fruition. So keep an eye on that package. Obviously, things in Washington are pretty tense right now, but it's, I think, in both parties' interest to ultimately come to an agreement, and that agreement would be supportive for stock prices. What this chart also has led to, though, is what are deflated bond yields. The central banks have done their best to stimulate the economy by dropping rates. The Federal Reserve has announced at least through 2023, rates are going to remain at 0%. And talking about bond yields and cash and interest is something that our clients are very, very interested in. Bryan's going to walk us through and kind of dissect the bond market for us on this next slide.
Thank you, Eric. So, excuse me, in the world of bonds, what we tend to find is many people are focused on treasuries. When they think of bonds, they think of government-based bonds. And what we know from the Treasury is they have pumped out trillions, literally trillions of dollars of new issue. What that has led to, along with an extreme flight to safety that we had in March and April, is a huge spike in Treasury prices, and a corresponding, if you know how Treasury or how bonds work in general, if the price goes up, your effective yield goes down. We have seen those yields go down and down and down and down to a point where it's really hard to justify really even owning many Treasuries at this point for individual investors. You know, maybe you have a reason for it, but it's hard to find. This chart will show you from left to right. The blue portion is the effective yield, what we call the yield to worst that you can get from some of these different types of bonds. The greenish bar next to it, excuse me, is going to be the length of time, the duration that it takes to get paid out. Duration is a measure of risk when it comes to bonds, along with credit quality primarily. Those would be two of the big ones. What we have noticed here is if you go to almost the right-hand side, broad treasuries, second from the right, is what we think of, what folks would think of as the bond market, even though it's much more broad than that. Excuse me. What do we get from broad treasuries? About 0.5% of effective yield. In order to get that, I have to take on 7 years of duration. That is not a great trade-off. I can get 0.5% of yield right now from a 6-month CD. Even when rates reset and drop down, I can get it from a 1-year CD. 1 year is a lot shorter than 7 years. What have we looked at? We have always had a position in corporate bonds. We have added recently a position to a manager that's more focused on corporate bonds than on treasuries, because we want to find some opportunity set out there to add some effective yield. Where is that going to come from? If I look in the middle of this chart, I can see corporates 1 to 3. I can see intermediate corporates. Corporates 1 to 3 per this chart gives me about 0.7% of yield, so a bit more than a treasury. And I can get it, in 2 years instead of 7. That's a much better trade-off to me. If you go over to the left-hand side, you notice that there's high yield corporates. High yield is another name for junk bonds, below investment grade. They're all the same thing. It is anything that's rated below BBB. There is a higher opportunity set there for yield, but there's also a much higher default rate. What we have looked for is a manager, and again, the one that we have selected and implemented, has a modest position to high yield, but enough to be worthwhile. And then the rest of their positioning is in A-rated to BBB rated. That's the majority of their position in corporates and some mortgages, things like that. We just, in general, believe treasuries, they might provide safety to some folks, but safety when you're losing on inflation, when you're losing on buying power, that's not the kind of safety that we're looking for. We want to go to that next level and find something better. And speaking of yield, here are some other ideas.
So what this chart shows are where we think some of the values are out there for investors. And Bryan mentioned short-term treasury bonds have a yield of 0.05 approximately. That's also about what you're going to see in money market accounts, probably a little more than savings accounts these days. So finding cash solutions for clients is definitely a challenge. And looking for other income producing vehicles is something that's very worthwhile to do. Continue down this chart. Long-term treasury bonds. That's where really the riskiest sector of the treasury, the treasury yield curve, 1.27%. So even going out 20 plus years on your bonds, you're only going to get 1.27%. Not very attractive when inflation today is running, core inflation, right around 1.7%. So we're not in a deflationary environment. We are seeing some inflation out there. There are certain things that are where prices are coming down, particularly rents in urban areas are coming down. But for the most part, our economy continues to see mild inflation, but still below the Fed's target of 2%. So where can we find yield? Well, aggregate bonds are a little bit better. They're less risky than long-term treasuries, but they still yield 1.2%. High yield bonds, which are really the riskiest portion of the bond market at 4.6%. That's a nice piece, a nice component of a portfolio, especially if the economy is going to continue to recover and continue to grow. High yield generally has fewer defaults when we're in a growing economy, but it's something to be aware of, that there's a default risk there, and they're generally the riskiest sector of the bond market. We really like large cap stocks, and those of you that know Cutler know we're dividend investors, and we believe dividends can create value. The dividend sector is best defined here as value stocks, having a 3.2% yield. That's triple what a 10-year treasury will get you. So we think investors do have an opportunity looking at those value sectors. We've had a long-term period of growth outperforming value. That may be beginning to shift, largely because of this income dynamic. Investors really need cash flows in their portfolio. And one of the best ways, if not the only way, to achieve any sort of material income is through dividend stocks. Dividend stocks also exist outside of the US to a great extent. We really like international stocks as well right here. You can see 3.2% for international developed stocks is a very nice yield, very nice cash flows that can be a complement to client portfolios because of some correlation advantages. They don't behave exactly the way US stocks do. Their economies don't behave exactly the way US stocks do. This chart shows what I mean by that. So here we have the Peterson Institute of International Economics. It's a forecast on GDP growth and the recovery of all of these various countries listed. And what I would highlight here for the US is they're forecasting we get back to last year's GDP by next year. Now, I think that's an incredible economic recovery for a once in 100 years pandemic. To have a complete reversal and get back to where we were before in such a short period of time shows the resiliency of the U.S. economy, and ultimately, I think, is very supportive for U.S. stock prices. This is part of the reason why we think we can grow into today's valuations, and that investors should feel confident owning stocks for the long term. Now let's look across this chart, and you can see a little bit of a mixed bag. I'd highlight China. China hasn't slowed down. They're experiencing growth this year. They're going to experience growth again next year. And so investors in that stock market have done very well. Continue across, Brazil, on the other hand, has struggled. And the pandemic response is going to be a much harder road for them than it will be for a lot of other countries. So you have a little bit of a mixed bag here. But for the most part, most of the developed countries out there have recovered or are in the process of recovering back to where we were pre-pandemic. So, and what that also supports, and Bryan, I'm going to hand this off to you, but diversification remains the most important investment principle for our clients.
Absolutely. Thank you, Erich. So this is what I refer to as the quilt chart. This is a return by year, going back to 2005, of some major asset classes. This will include some bonds, two different types of bonds, aggregate and short term. It will have domestic stocks. It will have international stocks. When I look at this chart year by year, what you mostly notice is exactly the emphasis that we have on why you don't want to try to overweight or select just one or two different types of investments. We want to be broad-based. Why? Because I can see that sometimes my highest highs become my lowest lows very soon after, sometimes the exact next year. I also noticed that if I'll highlight two boxes in particular. The black box is the broad US stock, big stock index. That would be essentially the S&P 500 or the Russell 1000. That is value and growth together in one basket. Excuse me. Where does that tend to be? Not every year, and especially not recently, where it's been more of a leader than it often is. It typically ends up right in that middle tranche. What do I like about that? It gives me more, certainty is not a great word for the stock market, but it gives me a better feeling of having that as a base than I would if I said, you know what, we should really overweight is emerging markets or something like that. That's, excuse me, going to be a broad base that many clients have, big US stocks. One other box on there is the dark brown. Excuse me, I'm sorry about that. The aggregate bond index is going to be all aspects of those bonds we talked about before, the treasuries and corporates, et cetera. What do I notice about that box? It tends to either be down near the bottom or up near the top. If it's up near the top, we're typically having a bad stock year. If it's down near the bottom, we're typically having a good stock year. But what do I notice about the brown? If I really look at the numbers inside, with very few exceptions, it is almost always a positive number. Bonds don't always shoot the lights out. In some years we say, oh, why do I even own these things? You own them for is downside protection and some recurring income. In an environment like this, it behooves us to think about what kind of bonds and also thinking about some income equivalents that Erich referenced before, such as foreign stocks, et cetera. But overall, there is a method to that madness of having some significant amount to both big US stocks and bonds. And then what do we do from there? We fill in the gaps with other areas like emerging markets, for example, which I've read this many times, so I can tell you, has had more times in the top two or bottom two on this chart than any other class. It is either boom or bust, but the booms are a lot bigger than the busts. So we want to have some there. We want to have some in international developed, especially now for the yield comparisons and lower valuations. You want to put this all together, but at the end of the day, why do so many clients tend to have a cornerstone of both big US stocks and bonds? This chart would play that out very well. If I look at this year to date, what I notice is the two top classes are large cap growth stocks, which tend to be very volatile, and bonds. What does that tell me? It tells me that this is a year where we've had a lot of disparate opinion about whether we're going to rally back or whether we should be sort of more bunker mentality. So if you say, are we risk on or risk off right now? The answer from some people is just yes, right? It's not yes, but or anything like that. It is just a difference of opinion there. So this is a year where some categories that I would not expect to be going together have come closer together. That's just another reason why this year is so unique. But what has really helped people out to stick with their allocation mix, to ride back up from the lows that we experienced in March and into April, and cross back up to a new high before now, where we are near highs, right? Who would have expected that in April? Well, who would have expected what happened in April to have happened when we were back in January? Neither of those. That's why we want to be prepared. Upside potential, downside protection. That's how we build portfolios.
So finally, I just want to say thank you all for joining us today. Again, if you do have questions, feel free to follow up with us. We're available to answer them anytime between now and the end of the year as this election unfolds and the stock market unfolds. And please look forward to our next quarterly webinar in the beginning of 2021. Hopefully 2021 will bring more similar stock market returns, but better news for everybody. I want to wish you all well, and thank you for joining us today.
Thank you all very much. We appreciate your time.